Okay, we finished off the last video talking about this transaction here. It's explained a little more down here, but the common stock account is the number of shares issued times par value. Now, any additional amount that was paid in by the investors who bought stock goes into additional paid in capital. And again, that's explained right down in here. They make the point down here that if one investor sells their stock to someone else, that is not a transaction that the corporation needs to record. All they do is record that there's a new owner of those shares. So what price they sell it for is not significant to the corporation itself. Now, obviously, it's important to the two individuals involved, but that's part of the separate entity assumption. The owners are a separate entity from the business. Okay, they move down here to the repurchase of stock, and that's where we get into treasury stock. So, and they deal with the issue here of why would a corporation repurchase its own stock? And I'm really not going to get into that. That's finance issues. That's really not a concern from accounting. From an accounting standpoint, we're just concerned with how do we account for it. And the most common method is what's called the cost method. And we just account for it at cost. So if we repurchase treasury shares, in this case, they repurchased 50,000 shares at $25 per share, or for $1.25 million, or $1,250,000. Then we would account for that by debiting treasury stock for the amount paid and crediting cash. That's a reduction of cash and a reduction of stockholders' equity by an increase in treasury stock, which is, again, a contra owner's equity account, carries a debit balance. It represents the amount that we have paid to reacquire our own stock. Okay, now again, I talked about this earlier. Treasury stock is not an asset. It is a permanent account, but it's a contra equity account, reducing the amount of total stockholders' equity. Okay, they give you a practice problem there. You can work through it. Here are the answers, and I encourage you to work through those. Now, what happens when we sell treasury stock? That's called a reissuance of treasury stock. And so how do we handle that? Well, basically, we sell treasury stock. We're going to debit cash for the amount of cash received. We're going to credit treasury stock at cost. And then any difference goes to additional paid-in capital, not to a gain or loss account. The reason we cannot recognize gain or loss, we cannot recognize profit or loss on transactions with our owners. So in this case, they took some of that stock they had bought for $25 a share. Price had gone up to $28 a share, and so they sold 5,000 shares for $28 a share. So that brought in $140,000. We increase cash or debit cash for that $140,000. We credit treasury stock at the $25 a share we paid. So 5,000 shares times $25 per share. Right here, we credit treasury stock. That removes it from treasury stock at the price we paid for it. And then the additional $3 a share on 5,000 shares, or $15,000. It's credited to additional paid-in capital. That's additional contributed capital contributed by the owners. All right, and in this coach's tip, they remind you that treasury stock is a contra account, contra to the common stock and additional paid-in capital accounts, and it's a contra owner's equity account carrying a debit balance. Okay, let's go over some homework problems here. So we're going to do mini exercises 11.2, 11.3, 4, 5, 6, and exercise 11.8. So let me pull those up, and there are the problems. So mini exercise 11.2, face-to-face corporation. Reports never had that name to mean so much to me as it does right now. Excuse me there, just about to sneeze. Okay, reports 100 shares, 100 outstanding shares, 500 authorized shares, and 50 shares of treasury stock. How many shares are issued? So remember, issued shares is outstanding shares plus treasury shares. They have been issued but are outstanding, but are not outstanding now. So there we get to our answer. There are 150 issued shares. That's the outstanding shares plus the treasury shares. Okay, let's go down to the next one. The balance sheet for Crutcher Corporation reported 200,000 shares outstanding, 300,000 shares authorized, and 20,000 shares of treasury stock. Compute the maximum number of new shares that Crutcher could issue. Well, the only new shares they can issue are the ones that have not been issued already, right? So how many have been issued? Well, 200,000 shares outstanding plus 20,000 shares of treasury stock. So 220,000 shares have been issued. So only 300,000 minus 220,000 shares, or 80,000 shares, are new shares that can be issued. They can also reissue these 20,000 treasury shares, but they are not new shares that are being issued. They are being reissued. So remember, our answer is 80,000. And if I can find my cursor, there it is. And there is our answer. They can issue 80,000 additional shares, new shares. Okay, now it looks like we got some journal entries coming up. So mini exercise 11.4. To expand operations, Argonne Consulting issued 1,000 shares of previously unissued common stock with a par value of $1. Price of the stock was $50 per share. Analyze the accounting equation effects and record the journal entry for the stock issuance. Would your answer be different if the par value were $2 per share? If so, analyze the accounting equation effects and record the journal entry for the stock issuance with a par value of $2. So 1,000 shares, $50 a share, so they were issued for $50,000, $1 par and $2 par. So let me just go ahead and pull up the answer. Right here are the accounting equation effects, and notice the accounts involved are the same. The amounts over here are a little bit different between the $1 par and the $2 par, but ultimately the accounting equations effects are the same from a big picture standpoint. Cash increased by $50,000 in both cases. Stockholders' equity increased by $50,000. Now, in this example, $1 par stock, common stock increased by $1 a share times 1,000 shares, or $1,000. An additional paid-in capital increased by $49 per share times 1,000 shares, or $49,000. There's the journal entry: debit cash for $50,000, credit common stock for $1,000, credit additional paid-in capital for $49,000. $2 par, we still see cash increase by $50,000, debit cash for $50,000. We see common stock increase, this time by $2,000 for the $2 par value times 1,000 shares, and common stock, an additional paid-in capital increase by $48 per share times 1,000 shares, or $48,000. Credit common stock $2,000, credit additional paid-in capital for $48,000. So from a big picture standpoint, total assets increased by $50,000. Total stockholders' equity increased by $50,000 in both cases. Okay, another journal entry in 5. So refer to mini exercise 11.4. Assume the issued stock has no par value. Analyze the accounting equation effects and record the journal entry of the no par value stock at $50. Do the effects on total assets, total liabilities, total stockholders' equity differ from those in 11.4? Well, the second part is no, they do not differ, but the accounts involved do. Here we're just going to credit common stock for $50,000, and additional paid-in capital will not come into play because there's no par on the stock. So we increase cash again by $50,000, increase stockholders' equity by $50,000, debit cash, credit common stock for the $50,000 amount. And here they get in there, the effects on total assets, total liabilities, total stockholders' equity do not differ between the no par stock and the par value stock. Okay, looks like we got 3 transactions in 6. So pull it up a little more. Determining the effects of stock issuance in treasury stock transactions. So TransUnion Corporation issued 5,000 shares for $50 per share in the current year, and it issued 10,000 shares for $37 per share in the following year. Kind of interesting. If they did that in the current year, then they're saying, gee, they did that in the future. Well, that's kind of weird to me, but that's just me. The year after that, so now we're getting 2 years in the future, the company reacquired 20,000 shares of its own stock for $45 per share. Determine the impact, increase, decrease, or no change of each of these transactions on the following classifications: total assets, total liabilities, total stockholders' equity, and net income. Okay, number 1, none of these are going to affect total liabilities. Also, none of these transactions are going to affect net income. So what happens to total assets? Here we have an increase in total assets, 5,000 shares times $50 per share. Here we have an increase in cash, so an increase, and we also have an increase in stockholders' equity by that amount, by the way. Here we have an increase in cash and stockholders' equity, and here we have a decrease because they bought treasury stock. So we have a decrease in cash for the purchase of these shares and a decrease in stockholders' equity because of the treasury stock, which is a contra stockholders' equity account. Now I'm about to run out of time, so I'll show you the answer there, and I'll come back after on the next video and explain this answer.